Scott Talbott is Senior Vice President of Government Affairs at the Financial Services Roundtable. We're pleased to have him join us now live from our Washington newsroom to help with a little perspective on regulatory reform. Welcome to you, Scott. So where do we stand with all of this right now?
Yeah, we expect to see a bill in a couple of days. Could be as early as Monday, could be as early as tomorrow. The process is very fluid, but the senators are working hard to narrow the gap and come up with a proposal that can be presented to the leadership in the Senate Banking Committee.
What are your thoughts? What is your opinion on the direction this legislation is headed?
Sure. First of all, we need reform. We have to strengthen and modernize our regulatory framework to prevent this from happening again. The industry is strongly behind a lot of these reforms. We expect to see something dealing with creation of a systemic risk regulator. We expect to see something dealing with resolution authority to wind down systemically important depository institutions and non-depository institutions. And we expect to see strengthened consumer protection. And these are all good things. These are all good steps to strengthen our regulatory framework.
A little bit more specific here on this fund for bailouts. $50 billion was the number proposed by Senator Dodd's bill, far shy of the $150 billion fund proposed by the House. In the commercial, Scott, you said that $50 billion could come down now to $20 billion, warning that this is a fast-moving process. So where do we stand on this fund to bail out these firms deemed too big to fail or are in crisis?
Yeah, first of all, they will create a fund that will be funded by the industry, so the taxpayer dollars are not on the hook. The difference is but not between 50 and 150. The 150 is the total amount of the fund. What we're talking about with the 50 and the 20 billion or the 20 billion would be the amount that is prepaid by the industry given to the Treasury to hold in case there is a failure by a systemically important institution. And that money would be used to cover the costs of resolving that institution.
All right. Where are the tensions here? Where are the points of issue that we need to get compromise on?
Sure. The biggest point is surrounding the CFPA. Where will it be housed? Will it be a standalone agency or will it be inside an existing regulatory body like the Treasury or the Federal Reserve? The next question is, what are its powers? Does it have independent powers or does it have to work with the prudential regulator? Those are two key sticking points that need to be resolved here.
All right. And then what about this decision for a consumer protection agency? How is that going to unfold?
Yeah, that's exactly. I think what we'll see is that's exactly what I'm talking about. I think we'll probably see it housed within a regulatory body like the Treasury or the Fed, and then it'll have powers to write rules and do enforcements. But it will have to check. We support having it check, the consumer protection piece, check with the prudential regulator to ensure that the two are operating together. It didn't work when we had the Fed or another regulator simply focused on the bank itself, and it won't work to have a separate agency simply focused on consumers. The two have to work together to provide the most effective rules to strengthen the overall system.
And then which agency or which regulator should have the final decision? I think there was some talk that that decision should be made by a bankruptcy court, whether an institution should be wound down.
Yeah, we strongly support using the bankruptcy process that's in place now instead of creating a whole new government agency. So if a company's going to fail, let's rely on the bankruptcy court as well as the priorities that exist in bankruptcy code right now for creditors and shareholders and unsecured unsecured debtors as well. So we think there will be a strong process for winding down those institutions, and that's where the $50 billion will come in, or $20 billion will come in to pay those costs so the taxpayer is not on the hook to cover the cost of a resolution.
All right. Appreciate your insight. Scott Talbott is the Senior Vice President of Government Affairs at the Financial Services Roundtable.